just sharing my thoughts, not financial advice, and what I'm doing in this market and where I'm looking to buy. I've been buying e.l.f. for over a year, as you all can see. I've been patient, and once I started run from 50 to 150 the first time, and then it came back down to 50, I said, I gotta load the boat. I gotta load the boat. Because I was literally like, dang, I did not get enough shares. Once that joint last year when it ran from 50 to 150, 120, I was like, I did not get enough. And I was adding more in the hundreds. Then I got more opportunity in the 50s and in the 70s. I bought today for 70 as well. I bought this week. I bought more at like 69, 70. My average is 70 right now. People sleeping on e.l.f. I was buying e.l.f. a year ago, February 2025. I was still buying at $75. e.l.f. is my consumer balance play. It's not another AI CapEx bet. The AI trade that I usually cover on this channel, are the chips, the data center, the software, massive CapEx cycles. So upside depends on enterprise AI demand and infrastructure spend. This is different. e.l.f. is a beauty retail distribution, brand culture, value pricing. Upside depends on consumer resilience and execution stabilizing. So overall, why I loaded the boat, the stock. What's up, fam? Welcome back to JRuss TV. If you're new to my channel, hit that like, comment, subscribe button. Cover all things business, investing, self-improvement content, and AI. AI has definitely been added into the channel now. It seems as though that's all I'm really be talking about now. But this video gonna be a little different. If you're returning to the channel, appreciate you tuning back in. You already know what's up. Back with another banger. Back with giving out some more of my thoughts. This video, as you see by the title, is e.l.f. Now, this is a little different. If you've been following the public portfolio, which I started sharing this about a year and a half ago. If you've been following this public portfolio, my Robinhood that I cover in the channel, I've been invested in e.l.f. recently. More recently, I think the past month, I bought some shares in e.l.f., as y'all can see here. And I thought I'll make a video on this. It's been trading upwards. It's bottomed around $50, and it's currently at like $78, $80 right now. So it's gone up like 50% in the past month, which e.l.f. tends to do. I've been buying this company for over a year now, and the opportunity presented itself again to get back in at a very attractive price. So that's what we're going to talk about today: e.l.f. stock and why I loaded the boat, and why I'm still buying, in all honesty. So we can go ahead and get into it. e.l.f. is a misunderstood consumer growth stock, trading like the brand is broken. I still believe the value, beauty, culture, shelf space, and international growth still matter. So this is a beauty, value, Gen Z, non-AI diversifier for my stock portfolio. Literally every other company in my stock portfolio is tech. Related to tech somehow. This is the only company I have that's not. Oh, I do have a little bit of Celsius. I have a little sprinkle of Celsius in another portfolio, but it's nothing major. I've been in at a Celsius past 2 years. So the agenda, what we're going to cover in today's video is one, an overview, what is e.l.f. and why it still matters. The core thesis, so the distress and the durability setup that I'm seeing. Now I've still seen over a year, just a lot of things happening in the market, tariffs, all that. We're gonna get into that. Valuation, when the reset means for risk reward, the moat that they have, which is their brand, speed, value, and distribution network, consumer risk. So what's some tailwinds, what's some headwinds in this economy, and just why this is different from my AI trade investment thesis. Let's do a quick little overview of e.l.f. e.l.f. is a beauty platform built around value, speed, and culture. They sell mass beauty supplies, premium looking products at accessible prices. So I currently have some e.l.f. products too. I have their Naturium sunscreen. Let me just actually pause this right now. Well, I got it. I'll just show it up here. I have some e.l.f. products as well. So these are some video. If you don't follow me on X, follow me on X at JRuss TV. This is some products I have of Naturium, which is owned by e.l.f. So pretty much e.l.f. products. And honestly, I didn't even know that I was already using their products, until a friend told me and was like, that wash, they got some washcloths. They showed me some of their soap, their body wash. And I saw the name and I was like, Notorium. Why does that look mad familiar? Where have I seen that before? And it was e.l.f. I heard it in a review or something. I heard it and I was like, wait, that's e.l.f. company right there. Oh, e.l.f. owns them. And I was like, dang, I'm already using their products and I didn't even realize it. So you might own some e.l.f. products too. They include e.l.f. Cosmetics, e.l.f. Skin, Notorium, and Rode. Distribution combines major retailers, e-commerce, and social-first product discovery. Overall pitch: beauty product consumers can still justify when budgets are tight. Simple view: e.l.f. gives consumers a trade-down option without sacrificing trend, quality, or identity. e.l.f. is known as that affordable makeup brand. Now they've ventured off into some other premium brands like your Rode. But e.l.f. Cosmetics is, dupes, affordable dupes. Now, so here's my core thesis. The market punished e.l.f. like the brand was broke, but I honestly see a reset. My bet is the consumer pressure created a better entry point in a durable category, not a permanent brand damage. So this is my framework when it comes to finding these companies, investing in these companies. I covered this in a recent video that I'm putting out soon, or it might already be out, but how I 2x my portfolio in 1 year. Look at that video. I go over that a little more. But one, I find a theme: affordable beauty and value consumer. Two, research and infrastructure, retail shelf space, social discovery, supply chain, and brand portfolio. Assess durability. Moat must survive tariffs, inflation, and slower growth. Buy mispricing. Accumulate when sentiment disconnects from brand health. This is the same framework I use in my AI. Find a durable theme, look for a misunderstood infrastructure winners. And the entire industry has kind of been taking a pullback this past year. So if we look at some other competitors like e.l.f., but e.l.f. is more so a higher end cosmetic company. They own your Clinique, Origins, MAC, Bobbi Brown, Joe Malone, Aveda, Too Faced, Estee Lauder. But as you see, just from a stock price, year to date, they're still down 22%. Year over year, they're pretty much flat, similar to e.l.f. On the 5 year, they're down 74%. These are when you want to buy these companies, when they're beaten down and counted out for dead, or they're in their cycle. Like I said, this is a cyclical company. 5 years ago, well, this is their 2021, so that's a lot of money that was in the economy. A lot of money was in the economy. No cap. And all that got flushed back. But we're trading at 2015. We're trading at 2015 prices, 2014, almost a decade ago prices. Now, if we look at e.l.f., on the day, it's up almost 6% today. On the week, it's up 22%. On the month, it's up 48%. 3 months is up 26%. Year to date, it just broke even. And I've been e.l.f. for over a year. And when e.l.f. runs, it really runs. Like it can move pretty fast. As you can see here, up almost 50% in a month. Now I did buy 2 shares in the public account at $55 average. I'm up 40% right now, And then as you can see right here in my private portfolio, I was buying e.l.f. a year ago, February 2025. I was still buying at $75. I was buying at $65, $66, $67, $59, $56. And then even see it touched 45 again, 49. So that's when I knew that's the bottom for e.l.f. because it hit 49 last year and I was buying. I didn't check it out when it ran up. I was still buying. You see me buying at $80, see me buying at $91, started recurring buys. And then I was buying again at 100, Tuesdays $100, 130. Fast forward to 2026, a year later, I'm buying more at 62. I'm loading the boat. I'm buying again. So I just like to show receipts. If you're not familiar with Blossom, it's a social media app for investing, strictly for investing. So you can follow me on Blossom. This is my profile here. Link in the link below. But as you can see here, e.l.f. is let's see, 5% of the portfolio. right there. e.l.f. is 5% of my portfolio currently. And all-time return, I'm at 14% right now. Now I was down pretty bad. My average is around 70. My average is around 70. So I was down when it hit that 50. My average was around like 90, but I averaged all the way down to 70 once it bottomed again because I saw such a great opportunity. Now we're gonna get into why it fell and things like that. But let me look at e.l. stock too real quick. And this isn't e.l. isn't moving like e.l.f. is moving. That's because it's a bigger brand, it's older company, it doesn't move. But yeah, we're in e.l.f. We're in e.l.f. But yeah, the market is misunderstood. So why it got distressed? A good business can still become a hated stock. Like you see with Palantir. Palantir is a great business putting up record numbers, Nvidia putting up record numbers, but the stock is flat, or Palantir is down 50%, was down 50% like last week, and the business is doing better than ever. But sometimes you have to be prepared for your stocks to fall down 50%. Sometimes your company's gonna fall 50%. I had to realize that. I had two, Hood and e.l.f. I mean Hood and Hood, e.l.f. and Palantir all fell 50%, and AMD fell 50%. Pretty much all the companies I've been in, they all fell 50%. Now that I think about it, I had a big drop at one point, which created a buying opportunity for me to get in because fundamentals were going up, but the stock price was going down. That's when you buy. You don't want to buy chasing all-time highs, all that stuff. It's cool, might work, but it's a little more riskier. I'd rather get the not necessarily get the bottom, but add at a lower valuation. That's how you make more money. But it only rewards you if you're patient. You got to be patient. If you're not patient, you can end up selling. Trust me, I've been there. But got to be patient. But yeah, your best company is gonna fall 50%. And if you can't handle that, go invest in some ETFs. No cap. That's for the big boys. So one, the tariff shock. Once Trump announced tariffs on China being the highest, e.l.f. gets like the majority of their supplies from China. Not gonna lie. So that obviously hurt them pretty bad. China sourcing exposure and elevated tariff assumptions pressured the margins. Two, growth reset. The post-pandemic social media growth bar was too high. As you can see during 2021, even with e.l.f. stock, I don't think I did all the time, but e.l.f. was a $200 stock. e.l.f. was a $200 stock, guys. Look, 2024, e.l.f. traded at 217, 200s. People were wanting to pay 200s. Not too long ago, it was in the 140s. So I don't know. I like that ROI possibility. It's a high growth company. That's why I like it, and it's not tech, so it's like perfect. The consumer got hit. We had inflation, we had layoffs, we had debt. Essential shoppers made price more sensitive over this past year. Especially with this oil. They did say oil has been affecting them. It affects the whole business, and the consumer is hurting right now. Even though e.l.f. is the more affordable product, it still gets hit. It still take a hit. And even the last earnings call, the CEO Terang, he mentioned that they're actually lowering prices on certain products from like $14 to $10, and they're trying that out in different methods. They admitted it that the market was taking a hit, and the valuation compressed. High multiple consumer growth stocks get punished quickly when guidance resets. So the panic, lower expectations, cleaner risk to reward if execution stabilizes. Back to my framework of why I like companies that are distressed. Valuation snapshot, not cheap by classic PE, cheaper versus his growth story. So fair price is around $79-$80 right now. Market cap is $4.8 billion. I like me a smaller market cap because I have bigger growth. 45 PE, 1.64 billion in sales for full year 2026, 335 just EBITDA, 20% margin. The key is not whether e.l.f. looks optically cheap. The key is the market over discounted tariffs, consumer weakness, and slower growth. Sales still grew. Year over year, revenue still growth. That's good. That's important. That's important. Sales still grew. The question is margin recovery and confidence return. So overall, I'm gonna continue to watch the gross margin recovery after tariff pressure. Watch the core e.l.f. demand, not only road contribution. Watch international growth and shelf expansion. And that's another thing. The growth did slow. The core business only grew like 1% year over year. So that's another reason why. But road is going crazy. Moat and target demographic. Why the brand is harder to kill than the stock chart. One, value ladder, premium look at mass prices. Two is their speed to culture. They have like a 4 to 7 month time frame of when they can, get an idea of a new product or a new trend and have it on shelves within like 3 to 6 months, which is great. Fast product cycles and social listening. They're really in tune with their target market and they listen to them. Retail and digital, shelf presence plus online demand, community trust, inclusive, vegan, cruelty free positioning. Target customer, they have Gen Alpha, Gen Z, and millennials, value seeking, social native beauty buyers who want the look without the luxury price tag. Dupe culture is a demand tailwind, not just a social media trend. Some tailwinds and headwinds. Tailwinds, affordable beauty and pressure consumer economy, international runway and retail expansion. They have Rhode, Naturium strength, skincare portfolio, and Rhode has been putting up great numbers. Potential tariff and repricing relief support margin recovery. I think they might be getting a refund for tariffs, and I'm going to show a little clip from that as well. Some headwinds, core brand slowdown could pressure growth multiples, like I just mentioned. Consumer wallets are stretched by essentials. Tariff and sourcing exposure can help gross margins, but they are continuing to diversify from just China into other countries. And high valuation leaves little room for execution mistake. The investing question, are these cyclical / temporary pressures or signs the brand has lost durability? e.l.f. is my consumer balance play. It's not another AI CapEx bet. The AI trade that I usually cover on this channel, are the chips, the data center, the software, massive CapEx cycles. So upside depends on enterprise AI demand and infrastructure spend. This is different. e.l.f. is a beauty retail distribution, brand culture, value pricing. Upside depends on consumer resilience and execution stabilizing. So overall, why I loaded the boat, the stock sold off like near-term pressure equals permanent impairment. This is rewards patient investors. Affordable beauty can work when the consumer is hit because shoppers trade down. So makeup cosmetics is seen as a risk, a plus in recessions and things like that because people tend to shop at more affordable prices. They still have culture, shelf space, product velocity, portfolio expansion, and it gives me diversification away from AI while staying in a durable growth story. So just to go through some of my my X, if you don't follow me on X, make sure y'all follow me. But I talk about e.l.f. a few times in this portfolio. This is my portfolio at the end of 2025. Just she told me she paid $30 for lip gloss. I need to buy more e.l.f. I like e.l.f. considering and doubling down on Niveus or something else. So this is a quote from one of the earnings report. So the tariff rate is now at 45%. As you know, it has been as high as 170% earlier in the fiscal year. And if it remains at 45%, that becomes a little bit of a tailwind for us as we get into fiscal 27, given that we retained those higher rates as we started in the year. Bullish. The CEO to range, what I'm most excited about is that we have the ability to double our business again in the next few years. That's major for a company. Here's some buy orders I put in on May 21st. I said adding more e.l.f. more again soon, which is at $50. Like to show the receipts. I bought 10 shares at $54 here to add to my position. Main buys, my shopping list, e.l.f. under 65. A lot of times the best new company to buy are the ones you already own. Some of the products I've been buying, And just to end it off on the CEO, Tarang admin, he served as chair and CEO since 2014, led the company through a highly successful 2016 IPO and growing into a multi-brand powerhouse. So it wasn't just e.l.f. He did Naturium and Well People. e.l.f. Cosmetics and Rode, they bought for $1 billion. That's another thing too. The balance sheet does look a little iffy right now because they did drop $1 billion on Rode, but well worth it. So yeah, overall, this is my e.l.f. Thesis, quick PowerPoint for you guys. Hope y'all enjoyed. Just sharing my thoughts, not financial advice, and what I'm doing in this market and where I'm looking to buy. I've been buying e.l.f. for over a year, as you all can see. I've been patient, and once I started run from 50 to 150 the first time, and then it came back down to 50, I said I gotta load the boat. I gotta load the boat because I was like, dang, I did not get enough shares. Once that joint last year when it ran from 50 to 150, 120, I was like, I did not get enough. And I was adding more in the hundreds. Then I got more opportunity in the 50s and in the 70s. I bought today for 70 as well. I bought this week. I bought more at like 69, 70. My average is 70 right now. People sleeping on e.l.f. And it's different from the AI trade, which I love. I want a little diversity and I still get that high growth. JRS TV, we out.